Hi everyone, this is Professor Gallagher, and in this video we're going to cover Chapter 9, which we will discuss tax credits. The first tax credit that we're going to take a look at is the credit for child and dependent care expenses. So this is a credit that's available for working taxpayers to help with dependent care expenses. Qualifying expenses include those that are paid for household services and expenses that are paid for qualifying individuals so the taxpayer can be gainfully employed. A qualifying individual includes a person that is under the age of 13 for whom the taxpayer is entitled to a dependency deduction, or a dependent or spouse of the taxpayer who is incapable of caring for himself or herself. The credit is calculated as a percentage of the qualifying expenses that are incurred to care for that dependent. The percentage of the deduction is between 20 and 35%, and that's going to be depending on the taxpayer's AGI. The amount of expenses that can be used for the calculation is limited to $3,000 for one qualifying individual or $6,000 for two or more qualifying individuals. The expense amount is further limited by the earned income of either taxpayer or the spouse, whichever is smaller. In the case of a spouse that is not capable for caring for themselves or a full-time student, the non-working spouse is treated as having earned $250 per month if they have one qualifying person for the credit, or $500 per month for two or more qualifying persons. In the case of a student, we can only use the months that he or she is actually attending school. So this is the percentage table that is used to calculate the deduction. So if the gross income falls between these two numbers, then this is what we would multiply the allowable expenses by, that percentage in this column. Let's take a look at an example. We have Jamie, who is a single mother with one dependent child, Joey, who's age 7. She has AGI of $75,000, and she paid $4,500 to a qualified daycare center for after-school care for Joey. So we need to calculate her dependent care credit. So the maximum amount of her expenses that she can use to qualify for the credit is $3,000, and we're going to multiply that by the percentage based on her AGI. So her AGI is $75,000. So if we go back to the table, you will see that she falls in the last category of above $43,000. So the percentage that we're going to use is 20%. So 20% of the maximum allowed $3,000 is $600. Let's take a look at another example. Tom and Katie are married. They file a joint return and they have two dependent children, Jack age 11 and Jill age 5. Tom has an earned income of $41,000 and Katie was a full-time student for 9 months with no income. They paid a qualified daycare center and after-school care center $6,000. What is the maximum amount of qualified employment-related expenses that would be allowed for the child and dependent care credit calculation for Tom and Katie? Well, since Katie was a full-time student for only 9 out of the 12 months, her expense is going to be limited to $500 per month for the 9 months that she was in school. So the amount of related expenses that would qualify for the calculation is $4,500. We have Antonio, who is a widower and cares for his son, who's age 4. Antonio has AGI of $24,000 and paid qualified child care expenses of $2,900. In addition, Antonio received $1,000 of dependent care assistance that his employer properly excluded from Antonio's gross income. So we need to calculate Antonio's child and dependent care credit. So he had $2,900 worth of expenses. However, he received $1,000 of dependent care assistance that was excluded from his gross income. So that's going to further limit the amount of expenses down to $1,900. So now we need to look and see what percentage he qualifies for on our table based on AGI of 24,000. So he earned 24,000, so his percentage would be 30% to equal a total credit of $570. So next we're going to talk about the credit for the elderly or disabled. This credit is available for taxpayers who are age 65 years of age or permanently and totally disabled. The credit is equal to 15% of the allowable base amount, depending on the filing status and number of qualifying persons. The allowable base amounts are $5,000 for single taxpayers, or if only one spouse qualifies, $7,500 for joint filers when both spouses qualify, or $3,750 for married people filing separately. However, the base amounts must further be reduced by the amount of any non-taxable Social Security, or B, 1/2 of the amount that AGI exceeds the allowable base amounts, which are $7,500 for single, $10,000 for joint filers, and $5,000 for married filing separately. So let's look at an example. Joe and Sue are married. They file a joint tax return and are 70 and 60 years old, respectively. They have AGI of $12,000 and receive non-taxable Social Security benefits of $1,500. So the base amount would be $5,000. Since only Joe is over age 65, 1/2 of the AGI over $100,000 is $1,000. So their allowable base amount is $2,500, which when we multiply that times 15%, their credit would be $375. So now we're going to talk about the two educational tax credits that are available. There's the American Opportunity Tax Credit, the AOTC, which was also formerly known as the Hope Scholarship Credit. And then there's also the Lifetime Learning Credit. Both allow credit for higher educational expenses for the taxpayer, spouse, or their dependents. To file either of the credits, a Form 8863 will be filed. Qualifying expenses are amounts that are paid for tuition, fees, books, and other related expenses to an educational institution. An eligible institution is a post-secondary institution that is eligible to participate in the student aid program administered by the U.S. Department of Education. Almost all post-secondary institutions qualify for this. The American Opportunity Tax Credit is calculated as 100% of the first $2,000 of qualifying expenses and 25% of the next $2,000 for a maximum of $2,500 per student per year. So it's based on a maximum amount of $4,000 of expenses, which would give you a credit of $2,500. The Lifetime Learning Tax Credit is calculated as 20% of qualifying expenses for a maximum of $2,000 per taxpayer per year. A taxpayer may not use both credits in the same year for the same expenses. Both credits are phased out at certain amounts of modified adjusted gross income. The American Opportunity Tax Credit begins phase out at modified adjusted gross income amounts of $80,000 for single filers and $160,000 for married filing jointly. And the phase out ends completely at income amounts of $90,000 for single filers and $180,000 for married filing jointly. The Lifetime Learning Tax Credit, the phase out begins at $57,000 for single filers, phases out completely at $67,000 for single filers, and begins at $114,000 for married filing jointly and ends at $134,000 for married filing jointly. If the modified adjusted gross income of the taxpayer is within that phase-out range, the credit needs to be reduced by multiplying the amount by a fraction, which is calculated as follows. For the American Opportunity Tax Credit, we'll take the the top phase out range of $180,000 minus the modified adjusted gross income and divide that by $20,000, which is the phase out range. For single taxpayers, we will take $90,000 minus modified adjusted gross income and divide that by $10,000, which is the phase out range for single taxpayers. When the modified adjusted gross income is within the phase out range, the credit is going to be reduced by multiplying it by the following fraction for the lifetime learning tax credit. For married taxpayers, the phase out is calculated as $134,000 minus modified adjusted gross income divided by $20,000. For single taxpayers, the calculation is $67,000 minus the modified adjusted gross income divided by 10,000, which that 10,000 is your phase out range for that. So let's take a look at an example. Jules is a single taxpayer and paid $2,900 in qualifying expenses for her dependent daughter who attended the University of Arizona full-time as a freshman. How much is Jules' lifetime learning tax credit without any regard to any AGI limitations or other credits? So if her AGI is within the range, and she's not taken any other education tax credits, we would multiply the qualified expenses by 20% to give her a credit of $580 for the lifetime learning tax credit. So now we're going to assume the same facts as in 1. However, she has AGI of $85,000 and wants to claim the American Opportunities Tax Credit instead. What is her allowable credit after the credit phase out based on AGI is taken into account? So the amount of the tax credit is 100% of the first $2,000 and 25% of the second $9,000. So their maximum allowable credit based on the expenses of $2,900 would be $2,225. However, this amount is going to be limited by the AGI phase out. So we would take the allowable expenses and multiply it by 90,000, which is the top end of the phase out for a single individual for this tax credit, the AOTC, minus 85,000, which is Jules' modified AGI. And we're going to divide that by 10,000, which is the phase out range for this credit, which will give Jules an allowable tax credit of $1,113.